What if the biggest risk in the stock market right now isn't a bad company? What if the real danger is paying too much for a great story? Today, we're looking at 5 high-profile stocks where expectations are extremely high, and where even a small disappointment could create a large move in the stock price. These are not necessarily bad companies. In fact, some are among the most exciting businesses in the market. But when expectations become enormous, the margin for error becomes very small. So today, we're asking one important question. Are these 5 stocks approaching a last warning zone? The 5 stocks we'll examine are Nvidia, ticker symbol NVDA, Palantir, ticker symbol PLTR, CoreWeave, ticker symbol CRWV, AMD, ticker symbol AMD, and Tesla, ticker symbol TSLA. There is a common theme connecting all 5. Artificial intelligence, enormous growth expectations, aggressive valuations, or a combination of all 3. And that creates an important distinction. A company can have an amazing future while its stock can still be overpriced today. Let's start with Nvidia. This is arguably the most important artificial intelligence company in the world. Nvidia's latest reported quarter produced record revenue of $81.6 billion, while data center revenue reached $75.2 billion, up 92% year over year. That is extraordinary growth. But here is the problem. The better Nvidia performs, the higher the market's expectations become. Nvidia is scheduled to report fiscal second quarter 2027 results on August 26, 2026, making the upcoming report a major test for the stock. The Nvidia story depends heavily on continued artificial intelligence infrastructure spending. Investors are expecting enormous growth from Blackwell and future platforms. So Nvidia doesn't simply need to beat expectations. It needs to keep proving that artificial intelligence spending can continue at an extraordinary pace. The danger is simple. If growth remains excellent but comes in below extremely aggressive expectations, the stock can still fall. This is the classic problem with high expectation stocks. A great company can deliver great results and still disappoint investors. That's why Nvidia is on our warning list, not because the business is weak, but because the expectations are enormous. The bull case is powerful. Artificial intelligence adoption continues, hyperscalers continue spending, Blackwell demand remains strong, and Nvidia maintains a dominant position in accelerated computing. But the bear case is also clear. Competition increases, customers eventually demand better returns on artificial intelligence investments, export restrictions can affect certain markets, and valuation leaves less room for disappointment. So my Nvidia verdict is simple. Business quality is extremely high, growth potential is extremely high, but risk is also high because of expectations. Nvidia is not a sell because it's bad stock, it is a don't ignore the expectations stock. Next is Palantir. Palantir has become one of the market's favorite artificial intelligence software companies, and the growth story is impressive. Its latest reported quarter showed approximately $1.94 billion in revenue and $1.03 billion in net income, according to recent coverage. The company is also showing very strong growth metrics, which helps explain why investors continue assigning a premium valuation to the stock. But Palantir has one major problem. The stock price already assumes a lot of future success. Think about it this way. If Palantir grows rapidly, investors celebrate. But if Palantir grows rapidly and the stock is already priced for extraordinary growth, the company may need to grow even faster to justify the valuation. That creates a dangerous cycle. The higher the valuation becomes, the more perfect the future needs to look. And that means any slowdown in commercial growth, margins, government spending, or artificial intelligence adoption could trigger a major valuation reset. This doesn't mean Palantir's business is weak. It means the stock has very little room for mistakes. The key question for PLTR investors is not, is Palantir a good company? The better question is, can Palantir grow fast enough for long enough to justify its valuation? That is a much harder question. Recent market commentary has highlighted the stock's extremely high valuation relative to earnings, even as its operating growth remains impressive. My verdict is straightforward. Business quality is high, growth potential is very high, but valuation risk is extremely high. For Palantir, The warning sign is not necessarily the business. The warning sign is how much future success is already priced in. Now we get to a much more aggressive artificial intelligence infrastructure play, CoreWeave, ticker symbol CRWV. CoreWeave is essentially betting that demand for artificial intelligence computing infrastructure will continue exploding. And the growth has been remarkable. The company reported approximately $2.58 billion in second quarter 2026 revenue and expanded its backlog to roughly $104.2 billion. At first glance, that sounds incredible, but CoreWeave has a very different risk profile from Nvidia or Palantir. CoreWeave requires enormous amounts of capital to build and operate artificial intelligence infrastructure. And that means debt matters. A lot. In the second quarter of 2026, CoreWeave reported $640 million of interest expense, compared with $267 million a year earlier. The company also reported a $626 million net loss for the quarter. This is the central CRWV risk. Revenue can grow extremely fast, but if the cost of financing and building that infrastructure also grows rapidly, shareholders may not capture as much of the economic upside as expected. The bull case is easy to understand. Artificial intelligence computing demand could remain enormous. Large customers are signing long-term contracts. The backlog is massive, and CoreWeave could become one of the major infrastructure providers behind the artificial intelligence revolution. But the bear case is equally important. High capital expenditure, high debt, high interest expense, execution risk, customer concentration, and potentially intense competition. That combination makes CRWV one of the highest risk names on today's list. My verdict is simple. Huge opportunity, but also huge financial risk. Now let's talk about AMD. AMD is one of the biggest competitors to Nvidia in artificial intelligence accelerators, and the company is making real progress. In the second quarter of 2026, AMD reported $11.5 billion in revenue, a 54% gross margin, $2.0 billion in operating income, and $2.3 billion in net income. Those are strong numbers. But AMD has a different problem from Nvidia. It has to prove that its artificial intelligence opportunity can become large enough to support the expectations investors have placed on the stock. The semiconductor market moves incredibly fast. AMD has to compete with Nvidia while also dealing with custom silicon from major cloud companies and other semiconductor competitors. That means AMD's artificial intelligence opportunity is enormous, but execution matters. One recent valuation discussion highlighted how elevated expectations had become around AMD's forward earnings multiple. So the warning here is simple. The artificial intelligence opportunity may be real, but the market may already be pricing in a significant portion of that opportunity. If data center growth accelerates, AMD could continue surprising investors. But if growth disappoints, the valuation could compress quickly. For AMD, I would focus on three things. Number one is data center growth. Number two is artificial intelligence, GPU adoption, and competitive positioning. And number three is margins, because revenue growth alone isn't enough. Investors ultimately want profitable growth. If AMD can grow artificial intelligence revenue while expanding margins, the long-term story becomes much stronger. But if revenue grows while margins disappoint, the stock could struggle. So my verdict is, business quality is high, artificial intelligence opportunity is very high, and execution risk is high. AMD is a promising company, but promising does not automatically mean cheap. And now we reach the most controversial stock on the list, Tesla, ticker symbol TSLA. Tesla is no longer valued purely as a car company. Investors are also pricing in autonomy, robotaxis, robotics, energy, artificial intelligence, and potentially Optimus. That creates enormous upside potential, but it also creates enormous expectations. Tesla's second quarter 2026 results were mixed, and the company reported earnings per share of 33 cents versus an analyst estimate of 44 cents, according to recent earnings data. That gap matters because when a stock carries a premium valuation, earnings disappointments can become much more painful. Tesla's biggest strength is also its biggest risk, the future. If Tesla successfully scales robotaxis, autonomous driving, Optimus, energy storage, and artificial intelligence-related businesses, today's valuation could potentially look much more reasonable years from now. But what if those businesses take longer than expected? Then investors are left paying a huge premium for future possibilities. Recent analysis has also pointed to Tesla's profitability pressure, including a reported second quarter operating margin of around 1.41%. And that creates the central question: how much future success is already priced into Tesla? There is also a fresh headline investors should not ignore. Recent reports said Tesla is recalling approximately 2.98 million vehicles in China, creating another near-term risk factor for the company and its stock. But remember, a single recall doesn't determine Tesla's long-term future. The bigger issue is whether Tesla can simultaneously improve its core automotive economics while successfully turning its autonomy and robotics ambitions into meaningful businesses. That is a massive challenge. So my verdict is, innovation potential is extremely high, execution risk is extremely high, and valuation risk is extremely high. Tesla may have one of the biggest long-term stories in the market, but it also has one of the biggest gaps between current fundamentals and future expectations. So let's rank our 5 stocks. Number 5 is Nvidia, an amazing business, but with enormous expectations. Number 4 is AMD, a strong artificial intelligence opportunity, but with intense competition and valuation risk. Number 3 is Palantir, excellent growth, but extremely high expectations. Number 2 is Tesla, huge optionality, but major valuation and execution risk. And number 1 is CoreWeave, because the combination of rapid expansion, capital intensity, debt, and interest expense creates a particularly aggressive risk profile. But remember, risk ranking does not mean these stocks must crash. It means investors should understand what could go wrong. Before buying any of these stocks, ask yourself 5 questions. Number 1, am I buying the company or buying the hype? Number 2, what growth rate is already priced into the stock? Number 3, what happens if earnings are good but not amazing? Number 4, where is my downside risk? And finally, number 5, would I still want to own this company after a 30% correction? If the answer to that last question is no, you may be taking too much risk. So, are these 5 stocks doomed? Absolutely not. Nvidia could continue dominating artificial intelligence computing. Palantir could become one of the world's most important artificial intelligence software companies. CoreWeave could become a major artificial intelligence infrastructure provider. AMD could capture a much larger share of the artificial intelligence accelerator market, and Tesla could successfully transform itself beyond automobiles. But here's the lesson. A great company is not automatically a great investment at every price. The biggest danger isn't always a bad business. Sometimes, the biggest danger is an amazing story with impossible expectations. So before you buy, don't just ask, how high can this stock go? Ask yourself, what could make this stock fall? And how much am I willing to lose if I'm wrong? That is the difference between chasing a stock and investing with a plan. This is not financial advice. Always do your own research and consider your risk tolerance before making investment decisions.